All right, we're back at it another week, another Ask Me Anything happy hour. So we are so excited to be here to answer your questions. Hopefully, you've got some good questions, but we know you will because every single week we go live with this show, bring the whole team together, kind of like the Brady Bunch, to do one thing and one thing only, and that is serve you and answer your questions. So we're going to be streaming live today from Instagram, YouTube, Facebook, on all the different channels. So get your questions ready because in just a second, we're going to dive in. See you right after this. All the different channels. So get your questions ready. In a second, we're going to dive in. All right, we're back at it. Ask Me Anything happy hour is live. I want to do a real quick go around the block here, but let me move myself over to here. So I'm going to go that way. What way am I going here? Northeast, southwest, right there to this guy, Mr. Snaggy.
Hey, what's up, everybody? Happy Wednesday. Hope you all have a great week. It's been a fun day today with all the different shows. Of course, Wealth Webinar, incredible. Craig and Chris going through the 6 laws of wealth. That was really, really cool. A couple things real fast. I just thought I'd mention my wife and son just got home from the grocery store, and they said they came out of the grocery store, were sitting there on the curb and pulled up the app on their phone and had the Tesla pull out of the parking spot, drive through the parking lot by itself, and go right to the front of the store. Completely no driver in it, anything like that. So just unbelievable, the technology involved in that. I just thought that was really, really cool. Other than that, summertime, man. Summer's been kicking, and looking forward to answering all your questions here shortly. So I'll pass it over to Mr. Brian Fouts over there.
Hey, Brian Fouts here up in North Idaho, and you're sitting there talking about Tesla's pulling up, and I'm trying to fix a tractor from the 1930s. Those are the problems I got. I got 2 tractors that don't run right now. Yeah, so not nearly as sophisticated as what you got going on, but yeah, up here in the mountains, yeah, summer's in full swing here. My kids are actually getting ready to go out to the river, so we live right by a river. They're going to go in the swimming hole, go fishing, stuff like that. So, well, I get to have phone calls. My kids go out and have a lot of fun. So we're having a good summer so far. But with that, I'll go to the test.
Yeah. Hey, Fouts, real fast before you move on, I'll just add to that. So I just got an email from Security Mutual Life, which is one of the incredible, awesome mutually owned insurance companies that we partner with to do these whole life policies to create banking systems. And, we have a couple outstanding cases with them right now, people that are approved, ready to start their policies, and just letting us know, hey, we just need some paperwork to get these things enforced for these clients. And they said in the email, they said, very important, you can mail the required documents that they need to the home office, or SML can accept faxed requirements at a phone number. So I responded and just said, what is a fax? Like, I don't know what you're saying here. Like, is this new? Is this something that Tesla's doing? And I was informed a fax is a system they used 30 years ago to send documents before email. So I just thought that was interesting, but go ahead.
That's funny.
It's Tess, and I'm wearing my Your Own Banker shirt today. And I got to give the MSTV plug. I'll be live tomorrow, and I'm going to talk about premium rating controls and reinsurance. And I will be in MSTV for 4 more weeks, so please come on over and join me. And now it's to Craig.
Craig Yanni here, and I come from the south of Denver, Colorado. Beautiful state. I don't know about the politics here, but it's still a beautiful state. Now, in my neighborhood, there's been a lot of people moving in, people moving out. I've been in the same place for like 28 years. But on my door the other day, I got an invitation to a block party that's coming up in a couple of weeks. And the first thing it said on it was BYOB. And boy, did that catch my attention. BYOB, I'm bringing my BYOB to the party. Now, I don't know what they meant or how they knew I was doing this, but it's going to be an exciting block party if we're all talking about becoming your own banker. So anyway, I just got really excited about that. I want to share it with you. On to Linus.
Hey, Linus Note here from Hopkinsville, Kentucky. BYOB, yeah. There's a few other meanings out there. When I wear that hat, people are making guesses about what they think it means.
Yep.
Yes,
Does
sir.
it mean anything other than be your own banker?
Oh, do you want to know? Bring your own beer. There's others.
Yeah.
All right, well, get those questions in the chat box there. We'll go ahead and dive on into it.
Hey, before we dive into the questions, so I just want to also say we did something at Wealth Webinar today. We did a thing called Christmas in July. Chris was all dressed up. If you missed it, you missed a heck of a scene there. Props to Chris for throwing that costume on. It was pretty entertaining, but we did a really cool special. So we're doing one of our flagship live in-person events that we do twice a year. It's called the PMC Money Tank event. And it's where, all the stuff we talk about kind of meets reality, meets the real world in person. And people come to get educated on how to use their policies to invest in real estate, whether that's passive or active real estate investing. And we spend 2 full days together in a ballroom getting educated and networking and talking and building relationships. We go out at night and have breakfast, and it's just a blast. So we're doing something called Christmas in July right now. So the next Money Tank event is in Orlando, Florida, November 7th and 8th. But what we're doing right now is we're giving a discount, calling it Christmas in July. So I'll put this on the chat. But if anybody's interested, go over to privatemoneyclub.com/money tank. And for a GA ticket, use discount code Christmas in July. Or for a VIP ticket, use discount code Christmas in July VIP, all one word, Christmas in July VIP, but it'll give you $400 off a VIP ticket. And then Chris, I understand we still have a few hats left. So what we did, in addition to giving you a discount on the ticket, because it's Christmas and we're in a giving mood, we decided also for the first 10 people that they were going to receive a special BYOB PMC hat. So I'll show you a picture of that. So we still have, I think 3 of these left. I think there's 7 ticket spots. So 3 of these hats left. So if anybody right now wants to join us in Orlando, Florida, November 7th and 8th for the PMC Money Tank event, we'll also ship you one of these special edition hats. And I'm told we're not going to make any more of these. So you get one of the last ones.
Yeah, that's
be cool right there.
That's the last of those. That's for sure. So very limited edition.
So definitely grab that.
You don't want to miss any of these events. I have not missed a single event since they started in July of 2021, I believe it was.
That's awesome.
Yeah, you're
I
always
win the award.
You're always there.
That's awesome.
So anyways, I wanted to extend that invitation and just make everybody aware of it.
All right.
Cool.
Well, here, I'll kick out. Brian, you want to read the questions? I know you're pretty good at that.
Yeah. So we'll start with, let's see here. Kabbalah 6414. So IBC using a whole life policy, is it more financially beneficial to create a policy for yourself, age 52, or for your child or grandchild? Great question. I'll let someone take that one.
Yeah, definitely for yourself. If you're the breadwinner in the family, you would almost need to do it on yourself, because the insurance company typically will not allow a parent to take policies out on children if they don't have coverage on themselves first, because obviously it's really just an ethics thing. So I think from that standpoint, that's an easy decision. It would be on you. But the second reason would be, is a more deep rooted reason. Is I know IBC, we're doing it for the cash value growth, for the banking functions and taking back the banking functions, but there is a death benefit. So all the policies we do, although we reduce the death benefit down, there is a death benefit. So being what I'm reading here for your child or grandchild, I mean, you've got, protection should be of concern. I mean, you want to make sure that if anything ever happens to you, that your family's taken care of. So the death benefit on you, I think, would be the primary reason why you should look at it for yourself versus doing it on your child, and definitely doing it on your grandchild. But the second reason is the insurance company probably wouldn't even allow you to take out a policy on yourself or grandchild. Plus, at 52 years old, I know the reason you're thinking that is you're thinking, okay, they're younger, you're going to get a better, cash value growth because they're younger and the cost of insurance is lower. But actually, a lot of people think that way, and it usually doesn't play out that way. At 52, your prime age, like that's a really good age to do this. If you did it on one of the children, I don't know how old your child is or your grandchild, so that would be a major determining factor. But let's just say they're younger. Okay, you're 52, I'm 48, so I don't know. Let's just say they're like 10 years old or so. The amount of coverage that would be bought on the child, especially the grandchild, would be significant, because dollars go further in children's policies than they would with you. So we'd actually end up having to have a lot more death benefit on the child or grandchild's policies than we would on you, diluting that efficiency effect that you think you're getting because they're younger. So it's probably no better doing it on them than it would be on you from a cash value standpoint. And just based on this fact that you probably should have the death benefit on more than them would be the secondary factor. But there's other things that we'd need to know, like age of the kids and so on.
Yeah. And also the one answer is all the above. Do it on everybody. But start with yourself first, then kind of go down the family tree, so to speak. Good question. I like that one.
Sure. Yeah. And even just from the banking perspective and trying to dump in money or doing a significant premium for the infinite banking concept, a kid's policy is not going to be able to accept very much before you start hitting the maximums that an insurance company will allow. So an adult yourself would be the first one to go to. And even this makes me think, because my father just passed away 2 months ago at the age of 51, unexpectedly, a very aggressive cancer. And now he passed away without coverage due to his religious reasons. But for anybody and everybody else, they definitely should have had coverage. So I would start there. I actually just got news this afternoon of a colleague that got a very devastating health diagnosis very recently. I don't actually know what it is, but I think he's also about that age. So definitely something to be thinking about.
Yeah, actually, yeah, good thing to mention. And a good acquaintance of mine, same age as I am, mid late 40s, just found out just said he has Parkinson's. So
Oh my gosh.
Yeah, and the last time I saw him, which was about a year ago or so, I noticed he had a tremor in one of his hands, and he hadn't had it before, so I couldn't believe it. So yeah, I mean, yeah. When's the best time to get a policy? 20 years ago. Second best time is today. And those are good reasons right there.
For sure.
Yeah. Okay, so next question we got here. Let's see here. All right, so Andrew, is first lien HELOC to IBC policy, loan from policy back to HELOC, fund opportunities when available, pay down IBC loans and HELOC with returns from investments. Is this interest AR or arbitrage on the HELOC OTO? So there's a lot what you got going on right there. Now, when most people do what you're talking about, they go from the HELOC to the policy, and then they do velocity banking on the HELOC and then put the policy to work to create more cash flow that they can then run through the HELOC through velocity banking. That's actually going to be probably more efficient, but you've got to do the math for yourself and make sure that it makes sense to you before you do that. But most people don't go from the HELOC to policy and policy to HELOC because that doesn't really make sense. But that'd be a longer conversation for sure.
Yeah, I think he's got it in there, fund opportunity. So
yeah,
HELOC to IBC, loan from policy. Oh, I see. Yeah, loan from policy back to HELOC. Yeah, they're just wrong order is all. So HELOC, IBC opportunity, as long as there's a spread and there's an ample spread. So you got to be really careful here because now you're not just covering the loan from the policy, but you're covering the loan from the HELOC. And most of those are like 8 to 10%. So you'd have to make sure you're making adequate arbitrage and also doing it with the low enough risk because your house is on the line. Fund opportunity when available, pay down IBC loans and HELOC with returns from investment. So how I'd say that, Andrew, is like where we normally will talk about that type of a strategy would be in like high interest credit cards. So because it's very easy, that's a great strategy to do for high interest credit cards, especially in where this becomes really effective is when you're looking for the death benefit as well. You're looking to pick up death benefit coverage, pay down the debt or fund the opportunity using equity from your house because you're leveraging the equity, the money sitting lazy in your walls. You're using the policy to provide efficiency and long-term compounding growth, as well as the death benefit, which is kind of an added bonus you get from this. And then how we would normally show it is you take the loan from the policy to pay down the debts. You take the interest from the debts that you use to pay the credit cards, let's call it 25%. And then you would figure out, okay, how much of this payment that I was making the credit card, which at 25%, how much of that needs to go back to the HELOC to cover that debt expense? And then how much do I want to put back to the policy? So it's literally a mathematical calculation, and Craig and the advanced markets team and most of our team has the capabilities to show you the mathematics, but you would just want to run it. I mean, so we will never say that strategy is always an awesome strategy. It's literally a mathematical calculation to determine whether or not it will work. And then you got to make the the decision as to whether or not is the risk too much on the opportunity, or it kind of dilutes the purpose of doing it. I mean, open for other people saying something.
Yeah, and I would say there's always a short-term and a long-term perspective here as well. Mm-hmm. So what I mean by that is if you had the first lien HELOC, or you had the HELOC and you just put the money to work directly, you're going to have a shorter term benefit right away, because you don't have some of that early cost of the policy. Long term, though, it would be nice to be able to take the money, put it in the policy, have the policy compounding, and then take the cash value, put it to work in an opportunity, feed it back into the HELOC. That, frankly, is just going to take a little more time to get the wheels spinning. But long term, if you stick with it, it actually works out pretty well. So sometimes when we're talking about these types of situations, what I like to know is, what is your cash flow? What can you leave in the HELOC? What is your income? What's your expenses that you're, like Brian said, doing the velocity banking with the HELOC? What does that look like for you? How long would it take you to pay back some of that HELOC to buy it down? So all of those are ingredients that I would want to look at as I was kind of figuring out how to stitch this together. But those are some of my perspectives, short-term, long-term, and just understanding your cash flow.
One thing I want to bring up, and this is really, I just want to throw some gratitude out there into the universe. So the reason this show exists, it's called Ask Me Anything Happy Hours. There was this gentleman who I used to be pretty close with and used to do a bunch of stuff with, and actually hired him to be a mentor. His name was Steve Sims. And Steve Sims, in one of the mentoring calls that I did with him, had mentioned, hey, you should do an AMA. And at that time, I'm like, AMA, what the hell does that mean? He's like, ask me anything. And he's like, and he always loved his whiskey and his bourbons. He's like, you should do it, and call it a happy hour. So do it like at the end of the day, when people are kind of wrapping up and they might have questions that they learned throughout the day. You just do an hour-long AMA. He's like, I do it and people love it. And we just have drinks together and we do this AMA. So I wanted to give shout out, because Steve Sims did pass away. And just in light of like all these things we just said with, Linus's dad, and gosh, now we got, our colleague who got this bad diagnosis, which I got to call him right after this. And it's just been like one after the other. But Steve Sims, at a relatively young age, passed away, and this show exists because of him. So just wanted to throw it out there and, kind of look up and say, hey, Steve, thanks. The show is still going. Hope everything's good up there in heaven.
He was always good to have a nice old fashioned with too, man.
He loved those old fashions, and he was so much fun to be around, especially when he had an old fashioned in his hand, which was 99% of the time.
Yeah,
I've read a couple of his books too.
I attended a few of those AMAs with him also.
Yeah,
nice. All right, next question we got here from DW. Contemplating speculating in some covered calls ETFs with my IBC policy cash value. Having a hard time determining how much to pay back into my policy. I believe you recommend paying back as much as possible, but are there ever times you'd recommend just paying the interest and reinvesting everything else?
100%.
Yeah.
So I love this strategy. And it's kind of funny. And DW, thank you for bringing this up. I have not done any kind of lives or anything on this since the SODI days, which is going back, gosh, Stephen, when? 2021 or so? I think Stephen's hopped off. So this is a really unique one. We used to teach this, and I love this strategy. You just got to pick a good underlying ETF to do the covered call on, or good stock. I actually would prefer doing it with a stock. Not sure, why you'd want to do a covered call with an ETF when you can just find the individual stock. Maybe diversification. I get it. Whatever, to each their own. But we used to do it showing like a really high quality stock. A lot of times we would use dividend paying stock like Apple. And we used a couple other ones that had slightly higher dividends, and we would do a covered call on it. And we would just take, when you do the covered call, you're getting paid the premium. So we would take that and roll that back into the policy as a loan repayment. And then the interest on that is derived. So you could do it two different ways. We used to teach it with the full recapture, right? We would take the premium we got from the covered call, recapture it back up into the policy, and then just keep doing that. But we weren't really teaching like a long covered call strategy. We were teaching buy the covered call, and we would do like not swing trading, but we would buy it, get paid, and then just kind of find another opportunity. And we kept doing this over and over. So with what you're talking about, you're talking more of a longer term covered call strategy. In that situation, yes, instead of taking the premium and repaying back to the policy for the loan repayment, you could just use that to service the interest on the loan from the policy. And if you do it, I mean, and this is a really unique strategy, folks. Anybody that understands covered calls, it's kind of like what we love. It's a mathematical calculation. You can literally figure out what you're going to earn upfront before doing it. So you can find the right opportunities that would work in this strategy, because you could figure out, here's my loan interest, here's what I'm going to make on the covered call strategy, and here's the long-term strategy on that covered call. And then you could put that whole thing together. Matter of fact, I will get Sodi's in Dubai right now, but I will get him to come on and we'll put together a scenario like this. So give me month and a half, and we'll build a YouTube video all around a strategy like this, because it is a unique one.
Mm-hmm. I've had people asking about this kind of stuff, or doing options and things like that. And by all means, yes, you can. You just got to understand the underlying asset and the risk involved. Making sure you understand what you're doing. So yeah, I love it. All right. So Chris Christensen said, "Hey Chris, in Vegas, we spoke a couple years ago. Tried to get signed up, and they denied me because of medical on an elevated enzyme. I quit drinking and smoking since, and just wondered if there might be an opportunity to get me retested and see if it's changed." Yeah.
Yeah.
Absolutely.
100%. Like, giddy up and go. Who does anyone know that name? Who was the call with that you did?
It sounds like he said he spoke with you. So it sounds like.
Oh, might have been. Sorry, I was just kind of looking at it. So, hey, then if you spoke with me, the notes are all in the system. Let's do this. So let's get a call set up. Here, Craig or somebody, you want to put your email in there? Let's give them a link. And then, we'll book a call and we'll do that. Now that I look at the name, yes, it was me. That was a while ago. Awesome, man. Good to hear from you again. We were just talking about this today, about like folks that we spoke to a long time ago that, like, for one reason or the other didn't work out, and like how we were supposed to be reaching back out. But you saved me a call, Chris. You reached back out to us. So welcome back. Let's get you going.
Yep. I think I put the right link in there.
Yeah, check the CRM too. He should be in the CRM. He was in the old CRM, so it should have ported over to the new one. If not, I probably have his
He's
info.
in there, just not assigned anyone, so we can pick him up from there.
Yeah. Perfect.
All right.
Good to hear from you.
Yeah. All right. Mr. O'Mara, question is for Money Tank. Is there a parking for a rig or two so I could book a load to Orlando?
It's at a huge hotel, so I would almost certainly guarantee there is.
Yeah, park out back.
Yeah. Just don't park it in the parking garage.
You'll lose the top. So Mr. Shane, so for Chris, loved hearing how you're setting up the cash birthday gift for your descendants. What is an entry-level explanation of how you set that up? New policy in a trust equals birthday money gift.
Yeah, so entry level, super easy. So you set a policy up. That policy is owned by, just use a living trust, okay? It could be any trust structure, but let's just say a revocable living trust, which is kind of what I have set up. And the policy is taken out on me, but owned by the trust, and beneficiary is the trust. I pass away. A death benefit is paid to the trust. The trust basically will then be authorized to send checks out. So it would be, you'd need a trustee to be able to make sure that everybody born into your bloodline keeps track of that. So there's software that actually does this, and you would build it in so that on that birthday, the system sends that birthday card out with that check to that individual. And how that would work is so it never runs out of money. Let's just say little Johnny is born into the family. I'm gone. Vivi, has a child, and then Vivi's child has a child, and then we're going to call that little Johnny. So you're 2 gens down. So when Vivi passes, the trust is authorized to take out a policy on Vivi, which we've already got 2 policies on Vivi, and we'll have more. But that policy then, when Vivi passes, pays into the trust, funding future generations of these checks going out. Now, obviously, there's going to be way more money than what is going to be required just to mail these checks, because these checks can be any dollar amount. I had thought, and I guess I can change it anytime, like on birthdays, like $500. Just a reminder, right? It doesn't have to be a lot of money, $250, $500. So it's not like it's going to take a lot for the trust to generate that kind of income. It's really just about putting the language in the trust so that the trustees that succeed you know exactly what to do. And it just requires keeping track of all the kids born into the bloodline, making sure that the policies are being taken out on those kids when they're born and then throughout their lives as they utilize it. And here's the thing, because some of you are like, well, what if the kid doesn't want a policy? Or what if the parent of the kid doesn't want a policy on the kid? Okay, well then that parent that doesn't allow that policy on the child is no longer allowed to borrow from the family banking system. They got to go borrow from somebody else. But the family banking system is open to all members, family members, kind of silly, right? But like think credit union, open to all family members that are participating. So kind of like a credit union, you can't just walk into a credit union and become a member or open a deposit. You have to be a member. Well, the family banking system and the language in the trust spells that out, that every family member, we'll call members, has to participate in the family banking system for them to be able to use it. I went a little bit deeper and I probably should have, but
what with the Rockefellers does a pretty good job on that as well.
Well, that's where that comes from.
Yeah.
Exactly where that comes from. It's just, I just added an extra thing of that birthday check so that everybody remembers who Grandpa Chris is, even if they never, ever met me again and have no knowledge of me.
Yep.
They'll do the research when they get a check. Wow, I got a $500 check from Grandpa Chris. Who's Grandpa Chris? They go back in the family, logs and do some Google searches. Oh, wow. Look at this. That Grandpa Chris guy, he was a good snowboarder.
That's awesome. Keep the memory alive. All right. So Terry Isaac said, how much to start the policy?
$1 billion.
There's a lot of answers to this one. And so I always tell people it's the best number that it's a fit for your situation, what you're trying to accomplish. That's the best answer. Now, there are technical answers. So to make a policy work, 10 times your age per month, but that does not mean that's what you should do. So that's where, when we hop on a call with you, we'll walk through the different scenarios of what you're trying to do and what your numbers would be. And then it also depends upon your cash flow, though. But there's a lot that goes into what that number can be for you, in my opinion. So, anybody else want to chime in on that one? Or
I like that.
Perfect.
Yeah. All right, PB719X. Interesting. So I understand lending, real estate, etc. Does anyone take loans out to do, example, Roth IRA investing? So I think you're taking loans from your Roth, or what are they saying there?
Well, yeah, I have a self-directed Roth.
Well, I'm guessing, and I could be wrong. So PB719X Nike, if you could maybe rephrase the question, are you referring to like take a loan from the policy to invest in a Roth IRA? Or are you talking about using a self-directed Roth IRA to invest in things? Just kind of need to know what direction we're going here.
If you have a self-directed Roth IRA, yeah, you can invest it into qualified strategies for sure. Hands-off real estate investing, things like that. If you're talking about taking a loan from a policy, infinite banking, to go put into a Roth, I have never heard of anybody doing that.
No, that would definitely not be smart.
Yeah. So hopefully that makes sense.
And here's an easy way to look at it, right? If you just draw a line on a piece of paper down the middle, and on one side you write qualified, which stands for qualified retirement accounts, and the other side you write non-qualified. You never, ever, ever want to take money and cross the line in most cases, unless there's a real reason. Now, what do I mean by that? Well, if you got money in a qualified account, okay, like we'll call it a Roth is a bad example, but just a 401k. If you take it and you cross that line and move the money into a non-qualified account, like a bank account, you trigger taxes. And if you're not 59.5, you trigger tax or penalties. Now, going from non-qualified to qualified, that's done all the time, but usually on a systematic basis. So you'll fund a 401k, you'll fund a Roth, you'll fund an IRA, you'll fund like an educational IRA. You'll do that with systematic investments across the line. But if you had a policy, which already is on the non-qualified side, but the policy is very different than a bank account that you would normally fund from because it's tax-free and tax-deferred. So if it's built right, you benefit already from all those things that you would benefit from a Roth. So why would you go from a tax-free instrument into another tax-free instrument, but then lock the money up into a qualified account that falls under the rules of the IRS with the qualified rules? In a Roth, I know some of you are saying, well, in a Roth, it's just after tax dollars. Yeah, but you still got to leave it there for 5 years before you can access it. So you got rules to follow. And if you just keep it non-qualified in the policy, you don't have any rules because it's non-qualified, which kind of game on.
Yeah. Very cool.
That got real complicated real quick in my mind.
Did. I love it.
The theory was really simple, and I'm like, no, I kind of need a whiteboard to explain this.
Yeah. Well, congrats.
Well, I failed you in that answer, but sorry.
Yay, Kathleen.
Yeah, Kathleen and Adrian just got their first policy on Adrian. Just got funded, so that's awesome.
Nice.
All right, and you got to go in here. So follow up on my first lien HELOC question. If the policy loan interest rate is lower than the HELOC, would that be interest arbitrage? And then investments create more dollars, but HELOC is still low. This is what's been coming up on quite a few of my phone calls recently. Is like how a HELOC charges interest and how a policy loan charges interest are different. They're both called simple interest, but the way they charge it is not the same. And so I've been having to explain to people that how the interest is charged on policy loans. And once it kind of clicks, people are like, "Are you kidding me? That's how they charge the interest?" Because it's different. So they charge the interest once a year. So if you're paying a loan back on a policy during the year, every dollar you put in goes to principal, which means the amount of interest being charged is actually going down with every payment. So if you have a 5% loan rate on your policy, but you're paying monthly on it, the effective rate on the amount you borrowed is not 5%. It's going to be lower. That essentially is what velocity banking is, by the way. So I really wouldn't look at it as arbitrage, but you got to understand the interest, Andrew. So if you're doing velocity banking on the HELOC and it's 9%, the effective rate on the HELOC might be 6% or 5%. If you're taking the money from the policy and putting it into work and creating more cash flow can then go through the HELOC, effectively lowering the interest rate even more. Now, that can get very complicated. And we have some diagrams of that kind of stuff, but there's that's kind of what's going on there. But I don't know if I look at that as interest arbitrage from the HELOC to the policy. I'd look at the arbitrage from the policy to where you're putting it to work for you. I don't know. Maybe else has a different opinion on that one.
I literally like that one. You could go on for hours just going back and forth. The best thing to do would be just jump on a call with us, probably jump on a call with probably Craig and have him run the math with the tools that we have. Because I believe that would be a pretty easy one to show. What am I right, wrong in that, Craig?
Yeah, I think you're on the right track. I mean, the thing is when you're thinking about arbitrage, the question he's asking is there arbitrage between taking the money from the HELOC, putting in the policy? Well, in the early years, you may not be getting efficiency there. And that's why I was saying before, there's a short-term and a long-term strategy. But I'd be happy, Andrew, to jump on a call with you, run through some of the numbers. So if you want to reach out to me, that would be awesome. I just can't put my email in the chat. I don't know if Brian or Chris, you can put it in there.
Yeah, I'll put it in a moment. All right, so Xianru, I love that name. So hello everyone, good to see Brian's sexy head or brain. It's getting kind of long right now, actually. By the way, gotta take it off. I'm strategizing opening a second policy. First policy was open first quarter this year. No debt, comfortable cash flow. That's awesome. Congrats. A lot of our clients do second policies. But if there's a question here, and for other people that are thinking about second policies or why would you do that, the second policy is an option when you want to put more money through the policy that you currently have, but you can't because you've already maxed out the cash flow through that first policy. That's when you do the second one. So, and that's a problem that a lot of people have, and it's a good problem to have. Anybody else want to answer that one, or is that pretty much?
No, I think that's absolutely how to do it. I mean, I did a video, I don't know how long ago it was, about an old New York life policy I have showing just what that's grown to after 17 years. And I show it, just as a standalone policy, no IBC involved. I mean, so like a lot of people, when they're looking at this, I know we teach the IBC process, but just putting money in like one of especially the specially designed ones that we do now, and just leaving it sit there is still better than the alternative of keeping money in a bank account all day long, plus the death benefit, plus the protection from creditors and tax-free growth. I mean, it's just a better place to store your money, but then using it for IBC is a whole different world. I mean, that's like a whole nother level.
Yep.
I would just add, as far as your first policy that was just opened this year, some policies with some companies can accept some pretty significant extra premium So I would say contact your implementation agent or the carrier, the insurance company directly, and find out how much extra PUA premium you can add to the policy without creating a mech or violating any of their rules. And you may be able to put more money in there than you think. But it's just a matter of asking to find out.
Yep. HELOC Joe, no longer part of the team. No, he's part of the team. He's just doing a lot of events with his daughter. She does competitive shooting, so he's doing all that stuff this summer. But yeah, he's still around.
Our little junior Olympic.
Yep, it's awesome. All right, Knights of Israel. So what was the details of the investing opportunity that was on one of your videos about buying people's policies that need to sell them, if you guys remember?
Probably loosely talked about it. Like there's people that we set up with policies that down the line run into financial difficulty, can't keep their policy, and they may want to sell their policies. I don't remember doing a video about that.
So Chris, there was an opportunity, and I don't remember who it was with, but somebody was looking for a raise to buy someone's policy. It was
Must have been a
I
big
don't know
one.
if it was through Greg Hurlian, maybe.
Oh, yeah. The Unity Capital one. Yeah, that one's closed up. But I mean, yeah, that's what that one was, is Greg owned policies on, like he had bought policies, and what he was doing is he created a fund that allowed, well, he created an opportunity for people to invest money. He paid them interest, and it was backed by these policies. So that one, it's an interesting story. I'm not going to get into it here, but that guy died. So just like it was planned, like he was, on his deathbed when the call was done, he died. And that money is, eventually going to pay out to the investors, which is us. It just has not yet happened because of some weird circumstances, but it's working itself out.
Yeah, I'd say the other option, if Knights of Israel wants to get into that type of investing, there's companies out there called life settlement companies, and you can invest with them. They're typically buying people's policies. They're probably in their older years. I mean, they're not looking for younger folks that have policies they want to sell. They're looking for the people that want to maybe cash out of their policies so they can do some big thing in the rest of their life. But you can join in and buy those policies with them in those life settlement companies. And then, of course, when they pass, the death benefit gets paid out to the investors. So it's kind of a win-win if you think about it. If the person doesn't want their policy, they're typically getting more money than what they could get on a surrender. The investors put the money in, and then at the time of that person's death, they would get that death benefit. So that might be something to look at if that's the investment strategy you want to do.
Yep. So this is a follow-up question. So Chandra's asking, what are your thoughts on using a PLOC plus some savings to open up the second policy and then repay the PLOC with the first policy? I don't like that, to be honest. It's not really my favorite way of doing it, if you're going to do that. But using a PLOC to fund a policy is the same as using a HELOC to fund a policy. It's just a matter of what you're using the policy for, what you're putting it to work for, because you can always do velocity banking on the PLOC and take the first policy and put it to work in an asset, creating cash flow that can then further pay the PLOC off, and there you go. But you just got to do the math and map it out, and it has to make sense to you.
Yeah, I mean, I'd have to believe. I mean, if you just did the personal line of credit and took that out to open a second policy, you'd never arbitrage that. The personal HELOC is going to have a much higher interest rate than the policy loan is. So it's like what Brian said. You'd need to add another level and find a place for that money to go and work.
Yeah, that's where the velocity.
It's kind of like layering. It's kind of like a layering. There's a lot of people out there teaching that, but that's just, I don't mean to be rude, but that's a commission play.
Yeah,
it is. Trying to make more commissions. I don't mean to say that, but I would never condone that if that's what someone was out there showing or teaching. No way.
Yeah.
I've had some folks come my direction that did that laddering strategy where they opened a policy, used the money from that to buy another policy, and then they did. Yeah. I think they did 3 or 4 layers deep, and then invested, lost the investment, didn't have the cash flow. So the whole house of cards falls. There's
a couple of people, I'm not going to throw anyone under the bus because I've already got myself in shit doing that. But there's a couple of gurus out there showing this kind of strategy. And it's just to me, it's just a commission play. And
putting other people at risk too, in my opinion.
Yep, I agree. It's just not a smart financial move.
Yeah. And this one's a good one. So Noreen is asking, what are your thoughts about taking a loan out to invest in crypto? So in this one, well, one, I don't do crypto, but cross out crypto and put in real estate, put in private lending, put in anything. It doesn't really matter what you're putting the money into. What matters is your level of understanding that asset, your control of that asset, your ability to actually manage the risk inside that asset. That is what you really have to look at. So that's my answer to that one.
Same here.
Yeah, I don't have any crypto anymore. I used to have quite a bit, but
I don't either.
I tell the story. I have a hardware wallet. I think I told this on this one before. I have a hardware wallet. I've had $5,000 of Bitcoin on it that was on it 6 years ago. And my kids got a hold of it when we were doing moving, and they destroyed the password card and reset the device. So I don't even know how much is on it. Last I checked, it was over 50,000, but I can never access it again.
It's kind of like that guy that was digging through that garbage dump for years and years and years trying to find his laptop with his crypto on it.
Yep.
That was like millions of dollars.
Oh, I don't want to think about that. All right. So Steve is asking him, what do you think about the best-selling book, Be Smart, Pay Zero Taxes? I don't know that book.
I looked it up. It says, be smart, pay zero taxes. Use the buy, borrow, die strategy to get rich and stay rich by Mark J. Kwan.
What year was it published?
Let me see if I can figure that out.
I'll see if I can look it up.
Yeah, I've never heard about that one. All right, we're looking that one up. Let's see here. So Noreen had another question here. She goes, I thought HELOCs charge the interest and take from each payment where the full payment is not going to principal. That is correct. So when you have on the HELOC, you have to pay a payment. Oftentimes it's interest only. You can just pay the interest on the HELOC, but that doesn't decrease the principal. So yes, that's a big difference between like a HELOC line of credit and a policy loan, which is kind of like a line of credit as well. How they charge the interest is very different. Infinite banking or velocity banking, I've done the math on it. It seems to work a lot better on a policy than it does on a HELOC because of the way they charge the interest. It is correct. So.
That book's fairly new. It came out in April of 2025. I haven't had a chance.
I haven't read that one.
Yeah, I haven't heard it either. All right, so let's see. End of the questions we got here. So Steve also says, I have term policy. In 5 years, premiums will go up to $580 per month. Well, so you have a term policy that it renews in 5 years if you want to, and probably goes up at that point in time. But yeah, term policies are not infinite banking, but they do play into how we build infinite banking. But yeah, I think you had a follow up note on it as well here. Okay, yeah. So yeah, go up to per month. What's your opinion on selling the property to use the money now? I'm 66 years old. I'm not sure about selling the property, what he means.
Yeah, what property? Let's see. Where's the first message? I have a term policy, 5 years. Premium will go up to 580. Not understanding what the property. What?
I don't know which property you're talking about. So if you have a property that has equity, which might be what they're talking about, there's basically two ways, or well, there's more than that, but two main ways to unlock the equity to put it to work: a HELOC or sell the property. There's refi loans, but those are, I'll be honest, in my opinion, they're garbage. But
it's just selling the policy.
Oh, well, yeah. You can't really sell a term policy because an investor.
Yeah, nobody's going to buy that.
That no one's going to buy it because it goes away eventually. And so if an investor buys a term policy, what are they hoping?
You better keep your door locked. That's all. Yeah, get a good alarm system. I mean, someone buys your term policy, you better be thinking, "Oh, who just bought my term policy?"
Yeah, the only way they win is if you get hit by a bus.
Yeah, and there's a time frame on that. So, yeah, and just so you know, Steve, no one's going to buy your term policy. There's no intrinsic value in your term policy. People only buy permanent policies, as far as I know. I know there's some companies that say they'll buy term policies, but they're looking to buy a term policy that's on like somebody that's got a critical, like, let's say you were on your deathbed and you just needed money and you were terminally ill. Maybe then you could sell it because they could then look at the actuary tables and say, okay, this person is going to croak before the term policy's up and we're going to get a payout, but it's a risky play.
Yeah. Linus, that's a lot more extra PUAs in there. That's awesome. How much of the 3,500 was base?
About 30%.
Wow. Huh. That's incredible. I love that.
Yeah, it is. It's actually on a kid's policy. It was pretty wild. Being a younger kid, every single dollar of PUA premium was buying $13 of permanent paid up death benefit. So it's very powerful.
Wow. That's awesome. Huh. I'm gonna have to see how. I'm gonna have to look at that because I'm doing one on my kids here soon. All right. So TC Chowdhury is asking, how long does it take before you can use the policy for IBC? I'm 45 old and want to see if this will work for me. So at 45, you're fine. But I mean, 2 weeks, 3 weeks, and you can use the policy.
We always say immediately in the first 30 days. And that really accounts for your bank being really, really, really slow.
And we have that look back period too. What, about 10, 14 days?
20.
Oh, 20 days.
Yeah, I think it's 20.
I was able to take a loan from my One America policy. I think it was 4 days after it went in force. So it definitely varies. Sometimes it needs to be longer.
Yeah. My mass was like 3 days. I mean, they're all pretty quick, but it's just safe to say, TC, that, immediately in the first 30 days, you'll have access. No ifs, ands, or buts.
Because the look back period would only apply that first year anyway, if you're renewing.
Yeah, Shane said it was fast when he did it as well. 46 years when he did his first policy. Yeah. Okay, so let's see. Any other questions we got? We got one from Shane talking about the GoFundMe project for financial education school for children coming. So Vivi did the good job on her drawing $10 or his was 10 with 10 blocks or something.
Mine would look like a pool maybe, but I'm not sure.
I think Chris is on a call.
Oh yeah, it looks like he is.
Yeah. I don't know how the GoFundMe is going. I don't know if anybody else does.
Well, let's just come back to this one when Chris is ready.
Yeah. Oh yeah. So
Chris is back.
Sorry. Yeah. Shouldn't have taken the call. I thought it was somebody that I needed to take. How is the fundraising going? So I'll just share my screen. Let me move this up. I got to move it up. It's going good.
Cool. Let's see. And then Linus, yeah, you mentioned the
there it is. So here's how it's going. So this is it. The building, Noggle Hall, we raised $3,310. And there's the write-up. So we're still raising. I need to start talking about it more. But doing well. Shane, I'll start calling out a little bit more in the coming webinars. We get so caught up in what we do, I often forget to talk about it. Thanks for the reminder.
Yeah. And then we're getting close at the end of this Ask Me Anything. So Linus mentioned or reminded me of this. The Money Multiplier Mastermind, October and December, 10% off with promo code NOLT. And I'll put a link in the chat for actually the event. So yeah, we got this coming up here in October in Denver. Actually, finally something that's close to me.
I'm going to be bringing my whole family.
There you go.
Very cool.
We love the little, so it's just a bonus that you and Verna are coming.
Yeah. Let's see here. All right. The wheelchairpreneur says, I'm disabled, so insurability is an issue. If I have to put a policy on cousins, what do I need to do to prove insurable interest? Also, if I get my 215, get my 215, are there opportunities to work with you? I'm asking because I want to look to buy a home and wanted to use IBC to do so.
Most two different people, but yeah. So
sorry that
cousins are tough. Linus, how do cousins work?
You cannot prove insurability on a cousin unless they're maybe your significant caretaker or business partner in any way, anything like that. But just from a family or relative standpoint, no.
Yeah, because it's if they pass away, it's what is the financial impact to you? That's really how they look at it. So, but it depends, and also for you being disabled depends on what kind of disability. So, I mean, I have clients that are in wheelchairs that are fully insurable. It depends on why. If it's an accident, paralyzed from the waist down from a car accident, that's typically insurable as long as there's no ongoing complications. But it just depends on what it is.
Yeah, it definitely depend on that. I mean, a lot of people that think they're not insurable because of a disability or something like that they end up being insurable. So we definitely want to check that. And then, to understand a little bit more about the 215, I would assume maybe that's a lawsuit or something. But, I think the best thing to do is just set up a call. Let's discuss the situation. Let's figure out what you're trying to accomplish and see if we can solve the problem.
Yeah.
We'll put the link. Actually, the link was up, but we'll put it up again to book a call.
Yeah. And then to follow up on TC Chaudhary's call. So he's had a question. He's talking about, 45 years old, how long? So if you're looking to buy a home with infinite banking, it depends on how much you're going to put into the policy up front to build it to that amount. So you'd have to put in obviously if you're buying a house, 300, 500,000, you have to put quite a bit into the policy in the first couple of years to get it to that level, or have a large amount already set aside that you can put through the policy. But I have someone that's doing this, but they are on a 5-year plan. And so to do the large amount required a very large premium to support the dumping, as we call it. But what we ended up doing with them is, instead of having that large premium and large dumping, they're spreading the dumping over 3 to 4 years with a smaller premium. So they're not having to have this big, premium on the hook, but they're doing it over to, I think, 3 years. And then they plan on buying a house after the market goes hopefully down for them, is what they're thinking. So hopefully that makes sense. And then mentors, I'll put the link in here again. So there's a link in the chat box right there. So use that link to grab a time with one of our mentors. And then let's see. Terry's asking a question here. What are your parameters for emergency funds, and how do you decide what % to keep investments moving?
I do 6 months of expenses, like household expenses, 6 months. That's emergency fund. But I double down my policies as my emergency fund. I just don't put that money out to work. I always sit on cash. So I don't just have emergency fund. So that's kind of common, 6 months, 3 to 6 months of expenses. But I do a war chest fund as well. So my policies, I keep cash in them for opportunities now. I never used to, but I do now, just because they've gotten bigger. So I can have money out there working and keep money in the policy, so that when an opportunity does come, I got the liquid capital to just deploy right there. So my answer would probably be, as much as you can do.
Yeah. As far as emergency funds go, I mean, if you have none, we'll start with 1 month, and then 3 months, and then 6 months. You got to kind of build it up. But yeah, for most people, they say, minimum 6 months is where you want to get to eventually. So, but that's a good question.
Yeah. But I think the wheelchairpreneur definitely needs to book a call. I think, maybe you're uninsurable, which, hey, that's just one thing. We'll get that right out of the way. But I think there's lots of other opportunities and different things we can work with.
Oh, CP. When are we coming to Denver? So the Denver event
is already got that.
October 9th through 11th.
Yep. There you go. All right. Is that all the questions? I think we got more in here.
Looks like we
4
got
minutes to spare.
No, this would be acro, short for acrobat, because he used to flip.
Oh yeah, not cash. Well, awesome.
Good stuff. Well, hey, that was pretty awesome. Thanks for running that one, Brian. But thanks everybody for joining us, and thanks for the rapid fire questions. They were fun. And sorry we can't always get into the nitty gritty of every scenario. That's why we always offer a free call to get together and discuss your needs and goals and figure out what is the problem, and can we provide a solution that will solve it, and offer that to all of you. Book a call. We got the link up there. It's pretty simple. 45-minute call. Let's dive in. If we need 15 minutes, great. If we need longer, we're there for you. So with that being said, we're going to wrap up this episode of Ask Me Anything Happy Hour, and we'll look forward to seeing you on the next one. Till then, have a good night.
Thank you.